Welcome back to Boni's Life, where we cut through the noise, ignore the mainstream hysteria, and decode the financial markets with absolute precision. I am Boni, and today we are diving deep into the current state of the cryptocurrency market. Whether you are a short-term scalper looking for the next quick liquidation wick, a mid-term swing trader trying to catch the next macro trend, or a long-term diamond-handed investor building generational wealth, this episode is your definitive, uncompromising guide to navigating the chaos. We are going to look at the hard data, the underlying macroeconomic forces, the hidden institutional money trails, and the technical setups that are shaping the market right now. And yes, we will figure out exactly what kind of market we are trading in today, because understanding the environment is the first rule of survival. So grab your coffee or your energy drink of choice and let us get into it. Let us start by looking at the big picture, the macro view of the digital asset space. As of today, March 17th, 2026, the total cryptocurrency market capitalization has successfully reclaimed the $2.61 trillion mark. That is a massive number, and it tells us a very specific story. Liquidity is flowing back into the ecosystem despite the global headwinds. The 24-hour trading volume across the board is sitting at a very healthy $136.3 billion. This is not a dead market. This is a highly active, highly liquid environment. Bitcoin, the undisputed king and the primary indicator of market health, is currently trading around $74,213, showing a slight 0.7% increase over the last 24 hours. It has a market cap of roughly $1.48 trillion and maintains a dominance of 56.8%. This dominance metric is crucial because it shows that when push comes to shove, capital still flees to the perceived safety of Bitcoin rather than speculating on smaller altcoins. Ethereum, the smart contract pioneer, is holding its ground at $2,332, with a market cap of $281.6 billion and a dominance of 10.8%. What is truly fascinating here, and what many mainstream analysts are missing, is the divergence in recovery. Bitcoin is only about 41% below its all-time high of $126,080 from October 2025. Ethereum, on the other hand, is still lagging significantly, down nearly 53% from its peak. This tells us that institutional money, the smart money, is heavily favoring Bitcoin right now, likely driven by the continued success of the spot ETFs and its narrative as a non-sovereign store of value in a turbulent world. The recent launch of BlackRock's staked Ethereum ETF is a positive sign, but it has not yet translated into the explosive price action we saw with Bitcoin's ETF approvals. Now, let us talk about market sentiment, because psychology drives price action just as much as, if not more than, fundamentals do. The Crypto Fear and Greed Index is currently sitting at 28, which puts us squarely in the fear zone. However, context is absolutely everything in trading. Just a few weeks ago, on February 6th, this index hit an all-time low of 5. To put that into perspective for you, that is lower than the sheer panic we saw during the catastrophic Terra/Luna collapse. We have just exited a grueling, soul-crushing 48-day streak of extreme fear. This shift from extreme fear to regular fear is a classic textbook sign of a market that is trying to find its footing and build a base. It suggests that the weak hands, the over-leveraged retail traders, have been violently shaken out, and the smart money is quietly, methodically accumulating assets at a discount. When we look under the hood at the derivatives market, things get even more interesting and, frankly, a bit dangerous. According to CoinGlass, the total open interest across the crypto market is a staggering $113.6 billion. On Binance alone, Bitcoin futures trading volume is currently 5 times larger than spot trading volume. What does this tell us? It tells us that the market is highly leveraged, heavily speculative, and driven by derivatives rather than actual spot buying. In the last 24 hours alone, we have seen about $437 million in liquidations, with the long/short ratio almost perfectly split at 50.79% longs to 49.21% shorts. The market makers are having a field day. There is a massive cluster of long positions sitting just below the $62,000 mark, and over $1 billion in leverage positions could be wiped out in an instant if Bitcoin breaks above $75,100 or falls below $72,100. This high leverage means we should expect explosive face-melting volatility in the near term. So we must ask the critical question, what type of market are we currently trading? Based on the empirical data, we are in a transitional, highly leveraged accumulation phase with strong bullish undertones. It is not a full-blown euphoric bull market yet, as evidenced by the fear and greed index still showing fear. But it is certainly not a capitulation bear market either. The total stablecoin market cap has just hit an all-time high of $317 billion, with USDT dominating at $187 billion and USDC approaching $80 billion. This is the dry powder. This is the ammunition waiting on the sidelines. When stablecoin supplies hit record highs, it usually precedes a massive injection of capital into risk assets. We are in a market that is coiled like a spring, waiting for a specific catalyst to dictate the next major directional move. Speaking of catalysts, we absolutely cannot ignore the macroeconomic and geopolitical landscape, because crypto does not exist in a vacuum. Right now, the Federal Reserve is holding its highly anticipated two-day FOMC meeting. The market is currently pricing in a near total chance that interest rates will remain unchanged. However, the rate decision itself is not what matters. Traders are hanging on every single word from Jerome Powell regarding the dot plot and future rate cuts. If the Fed signals that no rate cuts are coming in 2026, we could see a sharp, aggressive pullback in risk assets, potentially sending Bitcoin back down to test the $65,000 level as liquidity tightens. On the flip side, any dovish tone, any hint that they might ease up, could be the spark that ignites the next massive leg up. Add to this the escalating geopolitical tensions that are reshaping the global economy. The recent US-Israeli strikes on Iran in late February caused Bitcoin to drop from $72,000 to $63,000 in a matter of hours, wiping out over $300 million in leverage positions instantly. These conflicts have pushed oil prices above $119 a barrel, which threatens to reignite inflation and severely complicate the Fed's job. Furthermore, the implementation of a 15% global tariff policy is adding another thick layer of uncertainty to global trade and supply chains. In times of geopolitical stress, Bitcoin often acts as a dual-edged sword. It dumps initially due to sudden liquidity crunches as investors rush to cash, but it often recovers quickly as people realize its value as a non-sovereign, censorship-resistant store of value. Let us dive into the technical analysis, starting with the King Bitcoin. Looking at the daily chart, Bitcoin recently bounced beautifully off the 0.236 Fibonacci retracement level at $68,987. It has broken above the key resistance at $74,000, reaching its highest level since early February. The immediate support is now established at $73,000, with a much stronger, historically significant support zone between $71,500 and $72,000. The Relative Strength Index, or RSI, is sitting at a neutral 48, indicating that the asset is neither overbought nor oversold, giving it plenty of room to run in either direction. The MACD is showing a slight bullish crossover on the lower timeframes. If Bitcoin can sustain a daily close above $75,100, it will trigger a massive short squeeze, potentially propelling the price rapidly toward the $80,000 to $85,000 range. Now let us look at Solana, which has been a favorite among traders for its high volatility and rapid ecosystem growth. Solana is currently trading in the $88 to $95 range, recovering from a recent dip. The technicals show a potential head and shoulders pattern that could target $59 if it breaks down. But the bulls are fighting incredibly hard to invalidate this bearish structure. The RSI is neutral at 51. If Solana can break and hold above the critical resistance at $94, the medium-term target is a swift, aggressive move to the $100 to $110 range. However, traders must be cautious. Decentralized exchange volume on Solana has dropped significantly by 62%, although ETF inflows remain strong. This divergence between on-chain activity and institutional investment is something we must monitor closely. So, how do we actually trade this market? Let us break it down by trader type, starting with the short-term traders, the scalpers, and day traders. For you, this highly leveraged, news-driven market is an absolute playground. Your strategy should revolve around trading the ranges and playing the liquidations. Keep a close eye on the CoinGlass liquidation heat maps, with $1 billion in leverage sitting between $72,100 and $75,100 for Bitcoin. You want to set your limit orders just outside these zones to catch the wicks when the market makers inevitably hunt for liquidity. Use tight stop losses, because when the FOMC news drops, the volatility will be ruthless and unforgiving. Do not marry your bags. Take profits at predefined resistance levels and wait patiently for the next setup. For the midterm traders, the swing traders looking at weeks to months, your focus should be on the macroeconomic shifts and technical confirmations. We are in an accumulation phase, so your strategy is to buy the fear. The recent dip to the $68,000 region for Bitcoin was a prime entry point. Right now, you should be watching the daily closes like a hawk. If Bitcoin confirms a breakout above $75,000 with strong volume, that is your trigger to add to your long positions, targeting the $85,000 level. If the Fed comes out hawkish and we see a pullback, look to scale in heavily in the $60,000 to $65,000 institutional support zone. For altcoins like Solana, wait for a confirmed daily close above $94 before entering a swing long toward $110. Patience is your greatest asset here. Finally, for the long-term traders and investors, the strategy remains beautifully simple but psychologically difficult to execute. The fundamentals of this asset class have never been stronger. We have record high stablecoin supplies waiting to enter the market. Institutional adoption through ETFs is accelerating at an unprecedented pace, and the weak hands have been completely flushed out during the recent 48-day extreme fear cycle. Your job is to ignore the day-to-day noise, the FOMC wicks, and the geopolitical panic selling. Use dollar cost averaging during these fear-driven dips. The fact that Bitcoin is holding above $70,000 despite global conflicts, high interest rates, and regulatory uncertainty is incredibly bullish. Keep your assets secure, preferably in cold storage, and let the macro cycle play out over the next 12 to 18 months. In conclusion, the market is currently a high-stakes chess game. We have record levels of dry powder in stablecoins, extreme leverage in the derivatives market, and massive macroeconomic events unfolding right now. The transition from extreme fear to cautious optimism presents a unique opportunity for those who are prepared and disciplined. Whether you are scalping the liquidation wicks, swing trading, the technical breakouts, or accumulating for the long term, the key is to have a plan and stick to it relentlessly. Do not let the market dictate your emotions. Let the data dictate your trades. That is all for today's deep dive into the crypto markets. If you found this analysis valuable, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. I want to hear from you in the comments below. Are you buying this current market, or are you waiting for a deeper pullback? Let me know your thoughts. Until next time, trade smart, stay disciplined, and I will see you in the next episode of Boni's Life.